Welcome to my YouTube channel, The Executive Outcome. My name is Michael Mwansalioba. I'll be taking you through financial accounting, books of prime entry relating to credit transaction. The presentation outline is as follows. We shall look at an introduction, then look at analytical sales day book, analytical sales returns day book, analytical purchases day book, and followed by analytical returns day book. To start with, take note that this presentation explains how day books, books of prime entry, also known as books of original entry, are put together for credit transactions. Sales of goods on credit, purchases of goods on credit, and returns of items to suppliers or consumers are all considered for credit transactions. In this kind of transactions, items are provided or received, but payment postponed to a later date. Let's start with analytical sales day book. The sales day book or sales journal is a primary entry book used to record sales of items made on credit. The sales invoice serves as the basis for entries in the sales day book. The vendor creates it in duplicate or triplicate, as some businesses do, then issues the top copy as the original and keeps the duplicate copy for their own records. The sales day book is created using duplicate copy. Let's look at an illustration. This example looks at the following transaction which will be entered in the sales day book relating to 2023. For the month of April, we have 1st April, sold goods on credit to Mr. Chisunka for Zambian kwacha 540 kwacha net. VAT is charged at the rate of 16%. On 5th April, sold goods on credit to Mr. Nyendwa, 800 kwacha net. The customer is entitled to 2% prompt discount if payment is made within 14 days. So in this case, we have a cash discount being offered. April 13, issued an invoice to Mr. Mulolo, 400 kwacha net. Then April 15, sold goods on credit to Mr. Malama, 750 kwacha net. So with these few transactions, I want to show you and illustrate how you capture this particular information from the source documents, the invoices, onto the books of original entry. Now in this regard, we have noticed that there is a tax involved. Many are times when various books relating to financial accounting show the books of original entry but forget to illustrate how the books of original entry are going to be kept where tax is involved. I've taken this opportunity to demonstrate how the VAT aspect is tackled. In this regard, I want to also explain the importance of the use of VAT fraction. The VAT fraction is a fraction that is used to determine the VAT component in the amount which is inclusive of VAT. So to do that, I've looked at how you can be in a position to do the determination of VAT amount in a VAT inclusive amount. Let's assume that VAT is at 16%. Please note, the cost of goods or services are always taken to be at 100%. Therefore, a product or service charged at 16% VAT is taken to be 116%, which is VAT inclusive. To obtain the VAT element in the VAT inclusive amount, use the VAT fraction, which is 16 out of 116 as a factor. So that is what is going to be employed in this example of ours. Let's go back and look at what we have for the first transaction. 1st April, sold goods on credit to Mr. Chisunka for 540 kwacha net. VAT is charged at the rate of 16%. So since this amount does not contain VAT, it as it is indicated VAT exclusive, being given as 540 kwacha net, the recording will be done as follows. Look at Mr. Chisunka. You are going to have a sales day book with the various columns, which include the date, the customers, the folio, the total, the VAT column, the trade receivable, and other receivables. The folio is a column that normally is given to show the indexing, where you need to cross-reference the amount, for instance. So here we have Mr. Chisunka. You have seen there is trade receivables of 540. That is net, which is excluding VAT. So you calculate 16% of this 540, you are going to get the value added tax of 86 kwacha for tengwe. So meaning the amount inclusive of VAT is obtained by adding 86 kwacha for tengwe to 540 kwacha, which is going to give 626 kwacha for tengwe. Let's look at the next transaction, which is one that took place on the 5th of April, where goods were sold on credit to Mr. Nyendwa for 800 kwacha net. The customer is entitled to 2% prompt discount, where payment is made within 14 days. So let's look at how this is captured in the table. Here is Mr. Nyendwa. The trade receivable shows the amount of 800 kwacha net. So all you need to do is find out what is 16% of 800, and you're going to get 125 kwacha for the phone, and that will give you the total of 925 kwacha for the phone. So that is VAT inclusive, 925 kwacha for the phone. Let's look at the next transaction. Now, before we get to the next transaction, I want to explain to you how you actually get the calculation of VAT. Where a discount is involved, as the case is in this Nyendwa transaction, a 2% cash discount is offered. So what you do is, first you find or you knock off the 2% from 800. That will give you an amount net of cash discount. That amount net of the cash discount is one that is used to apply the 16% to obtain the 125 kwacha for the phone VAT. That's how you calculate. So where the discount is involved, first remove the discount amount, then you can apply the tax rate to get the value added tax in this case, which is 125 kwacha for the Fongwe. Let's look at the next transaction. This happened on the April the 13th. Issued an invoice to Mr. Mlolo, 400 kwacha net. So there it is exclusive of VAT. So how do we record it? So Mr. Mlolo is showing that there is 400 kwacha trade receivables, and we calculate 16% of 400 kwacha. We are going to arrive at 64 kwacha. So when you add the value added tax to the trade receivable amount, we are going to get the total 464 kwacha. Finally, let's look at the transaction involving Mr. Malama that took place on the 15th of April. Sold goods on credit to Mr. Malama, 750 kwacha net. Likewise, we are going to just calculate the 16% of 750 kwacha. We get 120 kwacha as value added tax. Therefore, means that the total amount which Mr. Malama is going to pay, including VAT, will be 870 kwacha. So that is the recording. Now I want us to look at the journal entries for this type of transaction involving the month of April, if these are the only transactions that took place. So this is what we are going to do. You get the total under the total column, which is 2,885 kwacha 84 ngwe. So that is what is going to be shown as an amount which is going to be owing, which is owed to us by the number of trade debtors. This is total amount owed to us by the trade debtors, 2,885. So the journal entry is the journal is going to give us which account is to be credited and which account to be debited. So in this case, we are going to debit trade receivables with 2,885 kwacha 84 ngwe. What of the corresponding credit? The corresponding credit will be split between what is the revenue for the business, that is going to the sales account. So sales account is credited with 2,490. And what is due to revenue authority, in this case shown as a liability, it will be credited the VAT account in this case, which is going to be 395 kwacha 84 ngwe. These two make up the 2,885 kwacha 84 ngwe. That is the journal entry. Further analysis. The sales daybook can also be broken down into A, sales by product, and sales by location. All of these analyses are for management information only. They are not meant for information that needs to be recorded in the ledger. Furthermore, let's look at analytical sales returns daybook. As much as we can sell as a business goods to our customers, there are chances that these customers might not be happy with our goods for one reason or another, and therefore they decide to bring them back. These are sales returns. They are captured in the sales daybook. As such, a sales returns daybook is a prime entry book where items that were initially sold on credit but have since been returned are noted. The credit note is the primary record for returned products. The credit note is created in duplicate by the seller. who gives the top copy to the buyer. The duplicate is the one that is utilized to create the daybook for sales returns. Let's look at an illustration involving these two transactions. Let's take that Mr. Mwenyendwa returned goods on April 7th amounting to 200 kwacha net, and he is entitled to a prompt discount of 2%. And secondly, we have a transaction that took place on the 17th of April where we sent a credit note to Mr. Malama of 150 kwacha net. So how do we capture these in the daybook? Before I look at the actual entry on the daybook, I want us to maybe just a matter of giving you a flavor of how to deal with cash discount. So I want to explain how the cash discount is dealt with. I have two situations here. The first situation, A, says that given that the cash discount of 2%, and the amount net of VAT is 200, we need to remove the 2% to remain with 196. Okay, so this is how we approach this particular situation when calculating the VAT. So first remove the discount amount from the net amount. So we are going to get 2% of 200, which is 4 kwacha. Remove it from 200, we are going to remain with 196 kwacha. Then we use this 196 kwacha and apply 16% to it to get the VAT. Okay, that's the first situation. So if you look at the calculation in this regard, we are going to get the VAT in this case for Nyendwa amounting to 31 kwacha 36 singwe. Now I want to also explain a situation where you are dealing with a VAT inclusive figure, VAT inclusive amount. Given a VAT inclusive amount, to get the amount net of tax before discount, use VAT fraction to determine the VAT amount. Deduct the VAT from the VAT inclusive amount. I've demonstrated this particular calculation where you have, if you look at this question, okay, you are going to have a figure which is for 200 and if you add 196, you add 31 kwacha 36 ingwe, you are going to end up with 227 kwacha 36 ingwe. 227 kwacha 36 ingwe. So now, to get to the original amount, first of all, as I've explained, you remove the VAT amount. Remove the VAT amount from the VAT inclusive amount, so that you are going to remain with, in this case, 196 kwacha, which is going to be at 98%. 196 kwacha will be at 98%. Okay, because that is the amount exclusive VAT after the discount is removed. So the discount is 2%. To find the value before discount, that is 100%, the original value, use the relationship below. You have X equal to 100 and then 196 equal to 98%. So we want to figure out what is the figure at 100%? So you cross multiply. You are going to have 98x is equal to 100 times 196. So for x, you are going to have the 200 kwacha. We get back the 200 kwacha here. So in this particular case, we have 200 kwacha, which is the net amount. We have calculated the VAT, which is 31 kwacha 36 ingwe. We add that VAT, we get a gross amount of 231 kwacha 36 ingwe. Okay, so let's go to Malama. We sent a credit note to Mr. Malama of 150 kwacha net. 150 kwacha net. So here we go look at 150, calculate 16%, get 24. You add that one, get 174. That's a gross amount. So how do we make the journal entries? The journal, as before, shows which account to be credited and which account to be debited. In this particular case, we are going to show that trade receivables have to be credited by a total of 405 kwacha 36 ingwe. So this will be a reversal in the account for the trade receivables. So trade receivable is an asset, as we are going to learn later in the double entry rules. All assets are debited. So if you are going to reduce the asset account, it needs to be credited. So here we have seen trade receivables credited with 405 kwacha 36 ingwe. Then the VAT, here we are talking about our obligation as a company to the revenue authority. So the obligation of a company to a revenue authority represents a liability, and all liabilities according to the double entry rule are supposed to be credited. Since this is a return, it means that that liability has to be reduced. To reduce that account, you enter in the opposite, which is the debit. So you have to debit the VAT account with 55 kwacha 36 ingwe. Equally, the sales returns shows a reduction from our revenue. Okay, our revenue, as per general rule, the all income and gains are credited. So originally the sales account, when sales are made, the sales account is supposed to be credited. So when there is a reversal, we do the opposite, we debit that account. That's why here sales returns is debited. It's shown that it will be debited with 350 kwacha. So the sales returns account is showing how much the sales account will be reduced by. So this is 350 kwacha. Let's look at the analytical purchases daybook. The analytical purchases daybook, and the following things can be noted. The daybook for purchases is a prime entry book used to record transactions involving the purchases of items on credit. The purchasing invoice served as the basis for the entries in the sales daybook. The vendor creates an invoice in triplicate or triple, some business do, issues the top copy as the original, and keeps the copies. Let's look at an illustration. We have purchased goods on April 12th on credit from Mr. Kalava for 282 kwacha. The invoice stated a tax inclusive amount. So how do we deal with this transaction? So Kalava has an inclusive amount, which is a gross amount. It is a gross amount 282. So it will be entered in the totals column. Now we need to find out what is the VAT component in there. So here we apply the VAT fraction because this is a VAT inclusive amount. Means that to get the VAT, the 38 kwacha 9 tengwe, you multiply 282 kwacha by 4 divided by 29, which is the 16 over 116 in simple terms. So that's the one which is going to give you the 38 kwacha 9 tengwe. Meaning that if we remove the VAT from the 282, we are going to end up with 243 kwacha 10 ingwe as trade payable. We also have the next transaction, which is one that took place on the April 13, where we received an invoice for the 10-ton truck bought on credit from Tata Motors for 40,000 gross. So again, here we are. We have 40,000 kwacha under total since it's a gross amount. So what is the VAT component in it? Again, you apply the VAT fraction. You are going to obtain the value added tax included in the 40,000 kwacha as 5,517 kwacha 24 ngwe. So you remove that value added tax amount from the gross amount 40,000. You are going to end up with a net amount which is going to fall under other payable, which is 34,000 kwacha, 34,482 kwacha 76 ngwe. These are other payables because they are not part of normal trading activities. So we separate them for convenience and information purposes. We also have the April 18 transaction where we purchased goods on credit from Ms. Male amounting to 270. Again, this is a gross amount. Here we look at what we're supposed to do when dealing with this transaction, the purchase day book. So this is a gross amount 270. Again, we apply the VAT fraction to determine 37 kwacha 24 ngwe. When we remove it from there, we remain with 232 kwacha 76 ngwe. These are goods for normal trading activities. So they are falling under trade payables. We also look at a bill received for electricity on the 19th of April from Zam Hydropower. The total of the invoice was 320. Okay, so if this is the case, assuming that there is no VAT involved, okay, so then you are going to have 320 total and also put it under other payables, which is they are not part of the normal business activity. So we have the 320. So we add up the amounts columns. The total will give us a 40,872 kwacha. The VAT, total VAT will be 5,593 kwacha 38 ngwe. The trade payables will be 475 kwacha 86 ngwe, whereas the other payables will be 34,802 kwacha 76 ngwe. Let's look at how the journal entry is made. So we pick the purchases account from trade payables, okay, total, which is 475. That is going to be what our purchase account is going to reflect. We also pick our VAT liability to Revenue Authority, which is 5,593 kwacha 38 ngwe. We also look at the 34,482, which is relating to motor vehicles. We also look at the 320 kwacha relating to hydropower. So you can see that on the debit side, the purchases account, which reflects the increase in our stock, asset of stock. Since the asset is increasing, we debit it. So purchases account is debited with 475 kwacha 86 ingwe. So under the rules of double entry, when we have an asset increasing, that account should be debited. So the purchase account shows the movement of the stock item, and the stock is an asset. So when we purchase, the asset of stock increases, therefore purchase account, which represents the stock movement, will be debited. On the other hand, we have also the VAT account. Okay. We have also the motor vehicles account, debited. We have also electricity account, also debited. As an expense, all expenses are debited. So now we look at the aspect of other payables. These are liabilities. Okay. So we have other payables amounting to 320. These are liabilities. We have other payables, non-current assets, which is 40,000 kwacha. We have trade payables, which is again a liability, which is 552 kwacha. It should be noted that when a journal has been properly created, the sum of amounts in the debit and credit column will always be equal. This is another indication that you have understood or comprehended the idea behind double entry properly. So you can see that if you add the debit and the credit, they will agree to a total of 40,872 kwacha. Analytical purchases returns daybook. Purchases return daybook is primary entry book used to record the return of products that were first purchased on credit. The credit note is the primary record for the returned products. The supplier creates a duplicate of the credit note and gives us the top copy. The credit note's original copy is the one we utilize to create the daybook for purchases returns. Let's look at an illustration for this particular situation. I have with me two transactions. One that took place on the 13th April, the other one took place on the 19th April. On the 13th April, returned goods worth 64 kwacha to Mr. Kalaba. This is a tax-inclusive figure, whereas the 19th April received a credit note from Ms. Mwale for 108 kwachas and 5 ingwe, which is a gross amount. Let's see how this is handled in the books of original entry. As you can see, we have the columns: date, supplier, folio, total, VAT, trade, payables, and other payables. So for Mr. Kalaba, we have 64 kwacha, which is tax inclusive, VAT inclusive. So to obtain the VAT amount, we use the VAT fraction as I earlier explained. So when you apply the VAT fraction on 64 kwacha, which is 4 divided by 29, you are going to end up getting 8 kwacha 83 ngwe as the VAT component, value added tax. When you subtract from 64 kwacha the gross amount, you are going to end up with trade payable amount with a net amount of 55 kwacha 17 ingwe. Let's look at the next transaction, which is one that took place on the April 19th. Received a credit note from Mrs. Mwale for 108 kwacha 75 ingwe, a gross amount. Again, since it is VAT inclusive, you apply the VAT fraction on 108 kwacha 75 ingwe to get 15 kwacha as the value added tax. When you subtract 15 kwacha from 108 75 ingwe, you are going to get 93 kwacha 75 ingwe. So if these were the only transactions relating to returns, then you are going to get the totals. Under the total, you have 172 kwacha 75 ingwe. Under the value added tax, the total is 23 kwacha 83 ingwe. And the trade payables, 148 kwacha 72 ingwe. Let's look at the journal entries for this transaction. So before I talk about the journal entries, please note that value added tax calculations follow the same guidelines as those for entries in the purchasing daybook. The daybooks are nothing more than a list of the transactions that occurred throughout the time. They are kept on files as memorandum data for future use. So now let's look at the journal entry. As already noted, we are going to show that trade payables will be debited with 172 kwacha 75 ingwe, and the purchase returns account will be credited with 148 kwacha 72 ingwe. Also, the VAT component, which is 23 kwacha 83 ingwe, will be credited. Again, if you add the debit and the credit columns, you find that the two will agree to 172 kwacha 75 ingwe each, meaning that you have understood the double entry principles properly. That marks the end of this presentation. Please don't forget to like my YouTube channel and also subscribe to it. I look forward to meeting you again when I make another presentation. Thank you for listening.
Mr. Record.